Well, ladies and gentlemen, I am Sarah Lowther, and a very warm welcome to today's Master Investor webinar, which is showcasing the best in oil and industrial gases and energy-related opportunities. Now, over the next hour and 15 minutes, you'll get an overview of the established, the emerging, the hybrid, and as I've said already, the opportunities. Now, this is an interactive webinar, so if you have any questions you'd like to ask the presenters, please put them in the chat or the Q&A feature, which you'll see on your screens there, and we'll endeavour to get through as many as possible. Each presenter has 20 minutes in total, so we're going for about 15 minutes presentation and 5 minutes Q&A. Okay, to our first speaker now, who is setting the scene for the sector. It's Callum Macpherson, who is Head of Commodities at investment bank Investec. A very warm welcome to you, Callum.
Hello, Sarah. Thanks very much for having me on the show. And hello, everybody. Well, I should just start with a very quick disclaimer, just to say that I'm not a researcher, and nothing that I say should be construed as investment advice. But with that out of the way, let's get stuck into energy markets. So if I go to the first slide, please. Thanks very much. Actually, that's not the first. Is there another slide before that? That one. Perfect. Thank you. Thanks very much. Well, I think it's a good idea just to start high level with a look at the behavior of energy prices overall. So we have a chart here of oil and gas prices in Europe and Asia, and also US gas prices all in barrel of oil equivalent terms, so that they can be easily compared with one another. And what we've seen, particularly over the last 6 months, has been a normalization in the relationships between these different sources of energy. Typically in the past, gas has traded at a significant discount to oil prices, and US gas in particular has been very cheap due to its sort of relatively landlocked nature, albeit that changing to some extent with the advent of LNG. But these normal relationships were thrown completely out of kilter in 2022 because of the Ukraine war, and gas traded at a very substantial premium to oil. But now, as we see, that has moved much more back into the normal sort of relationships between these sources of energy. Well, let's focus now on the oil market. So if we could have the next slide, please. So for much of this year, Brent has been strengthening. This was fueled perhaps by two things, well, maybe three things in particular. One was the worries over supply and transport of crude oil connected with the ongoing war in Gaza, and disruption to shipping through the Suez Canal and the Red Sea and all that sort of thing, and indeed the possibility of an escalation between Israel and Iran. Then we've had, on top of that, OPEC Plus taking steps to try and manage the market with additional voluntary contribution cuts, which were rolled over during this period. And also, I think the economic climate has not turned out to be quite as bad as had been expected. So demand has been perhaps a bit stronger than people had feared. But this somewhat went into reverse in the last month or two. Oil reached a peak over $90 per barrel when there was the sort of peak concern about possible escalation between Iran and Israel. But as those concerns have faded, so the market prices have come back down again, and indeed have recently started to inhabit this sort of $80 to $85 per barrel range that was typical during March and February this year as well. Now, there was a wobble a couple of weeks ago when OPEC Plus unveiled their plan to unwind the additional voluntary contributions and bring more supply into the market, particularly into 2025. But that was then, that sell-off reversed quite quickly after the Saudis were very pointed in saying that there was a caveat that they might not go as quickly, or they might halt it, and so on. So essentially, sort of kicking the can down the road a little bit on when they would bring supply back into the market. Next slide, please. and you can see this this sort of the investment behavior coming through in these charts showing long the positions of managed money, speculative money in the market. You can see the green line, particularly on Brent over there. That's the net long position came down very sharply. So it had increased as investors were putting more money in, and have then become much more bearish again. If we turn to the next slide, we can see start to see or consider how this is looking from a consumer side. Again, rather like the gas market, the spreads between crude oil and refined products went completely haywire in 2022. We saw jet and diesel trading at premiums that we've never seen before over crude. But these relationships have started to normalize or have normalized. And particularly in the last few months, we've seen weakness in the refined product markets, and so the premium of jet and diesel over Brent crude has been coming down. There's been particularly strong supply from Asia in recent months, and this has tended to lead to the market getting a bit oversupplied in refined products, and of course ultimately that has to feed through into crude oil prices as well. Otherwise, the refineries will be losing money on continuing to produce products. We are at the start of the summer, of course. This is a peak demand season for the oil market. Increased jet, diesel, gasoline, and so on. And we would expect this to support prices to bring down some of the inventory and some of the excess supply. So the market is quite likely to be relatively strong over that period. But as we get into the autumn, once that's out of the way, then I think the questions are likely to come back around OPEC Plus and how it manages the market, and whether it's able to roll over these or able to go ahead with its plan to unwind the additional voluntary contributions, or whether instead it will have to continue rolling those over, albeit as painful as that will be for some members like Saudi Arabia. Let's now move on to the gas market. So if we could have the next slide, please. So European, this is a chart showing the trends in European gas inventories. The red line is the current year, and this is superimposed on previous years. So you can see that the gas in storage is around the highest level it's been at this time of year, looking back historically. So the market is in a good position from that perspective, and of course we've had 2 successive mild winters, and this has certainly helped this. But the question is, does this strong inventory position indicate that the energy crisis is over? Does the fact that prices in the gas market across Europe have returned to something like pre-war levels, and the curves now relatively flat, does this indicate that the problem has gone away? Well, if we go on to the next slide, please, we can see a recent history of gas inflows into Europe. So down at the bottom of the left-hand corner, you can see the various Russian supply coming through different pipelines. Obviously largely disappearing, although not quite. There is still some gas coming in from Russia through pipelines, ironically through Ukraine. Then we have, on top of that, we have the LNG imports, and on top of that we have Norwegian supply as well. And if you look at the top of this graph, which shows you total supply, so neglecting just the breakdown, you can see that overall the supply of gas coming into Europe, okay, it goes up and down quite a bit, but it is still quite a bit lower over the last couple of years than it was before the war started. So the simple answer to the question, has all of Russian supply been replaced? The answer is no, it hasn't. And that begs the question as to whether the market is being complacent, and what the risks might be in the gas market going forwards. Because the fact is, we've had 2 mild winters in a row. We've also had a reduction, so that's reduced heating demand, and we've also had a reduction in industrial demand as well. And these are things that could change. In particular, we might have an unusually cold winter this year, the situation could then look very, very different. We might see quite rapid drawdowns in gas inventories. It's also worth, when we're on the topic of volatility in gas markets, it's also worth thinking a bit about the changing role of gas in the power generation mix. And if we go on to the next slide, what this shows is the monthly average as a percentage of gas being used in the energy grid in the UK versus other sources of electricity generation, of course, including renewables. And clearly this moves around a lot, but it is noticeable there is a general trend towards gas making up a smaller proportion of the energy mix. And this is because it is increasingly being pushed out of providing baseload generation, which is sort of continuous supply 24 hours, 7 days a week, and is much more providing a sort of backup to renewables and coming on when renewable generation is low and switching off again when renewable generation is high. So there we are. So lots to think about in the oil and gas markets, and also their wider role in energy markets more generally.
Many thanks, Callum. You certainly tickled me when you said that the gas markets are possibly being a little bit complacent. But you talk about Russia and geopolitics quite a lot there. Which events really have the potential to change the dynamics in the oil and gas sectors? Would it be peace between Ukraine and Russia, or the world being bullied by a Russia-North Korea alliance?
Oh gosh, that's it's quite a question. Well, I don't. I mean, well, I suppose if there was peace with Ukraine today, and if Putin resigned, and that there was, and the Russians agreed to maybe pay reparations to Ukraine to rebuild the country, if all of those things happened, then maybe that would be the condition that the sanctions could be ended and supplies could be restored as before. But it doesn't seem very likely or very close at hand, I would say. So and North Korea, I don't know how much that really changes the story, to be honest. Now, there's already an alliance.
Understood. Now, as an investment bank, are you now paying more attention to the industrial gases, which have certainly caught government and retail investor imagination?
Do you mean the use of natural gas in industry, or do you mean
just as an investment bank, are you now apportioning more of your research time to looking at industrial gases, particularly as retail investors are very interested in helium-related stocks, for example?
Well, I'm not, as I mentioned at the outset, I'm not a researcher, so I'm not really involved in that side of thing. But I mean that side of things. But I mean, I don't see the role of gases broadly in the market having changed particularly. And obviously, helium is a completely different kettle of fish to natural gas in terms of its usage,
as we're going to find out within this webinar. So finally, what does the internet, I want you to summarize this for me, because I must admit I'm a bit of a nerd when it comes to the International Energy Agency. What does the International Energy Agency's latest report reveal about the state of the oil market now?
Well, it released two reports a couple of weeks ago, or was it last week, which were, I think, you may have been referring to either one of those, but they're both about the oil. So essentially, one is a short-term report and one is a long-term report. And the short-term report wasn't really dramatically different to any of their recent ones. That the message remains the same. That demand is growing and will grow again in next year, but that non-OPEC supply is their forecast is going to grow faster than demand. So consequently, so if you see, because they don't actually do a forecast for OPEC itself, but they say, well, in order to balance the market, OPEC is going to need to produce this. And what their report says is that in 2025, OPEC will need to produce about 26.5 million barrels per day, whereas it's currently producing about 27 million barrels per day, and that is with the additional voluntary cuts in place. So what the report implies is that even if OPEC carries on as it is, the market will be oversupplied next year. But if they go through their plan to unwind those additional voluntary cuts, then the market could be very oversupplied next year. So that's the way I would see that in a nutshell. But that's not changed particularly in their latest report. They've been saying that sort of thing for a while. I think what's much more interesting actually is their sort of medium-term outlook, which goes out to 2030, where they are saying that they see peak oil by the end of this decade at 106 million barrels per day. And that compares with current supply demand of around 103 million barrels per day. So really not very much supply growth, room for supply growth there going forward. And of course, the explanation for this forecast lies in electrification. So that the largest source of oil demand is road transport, making up for the best part of half of all oil production. And that is the part of oil demand that is most straightforward to decarbonize by electrifying it. And that process is underway, particularly strongly in China, of course.
Very good. Well, thank you. I'm going to have to stop you there. I realise that question, I've unleashed a beast. But
You could go on for hours, yes. But
Callum, thank you very much indeed. Callum Macpherson, Head of Commodities at the investment bank Investec. Thank you very much. And it's the first time I've heard the gas market being referred to as complacent. Thank you. Certainly something to mull over. Thank you very much indeed. Okay, to our our second presentation now, and it is ASX and OTC traded Kinetiko Energy Limited. It's helping to resolve the energy crisis in South Africa by developing the country's largest onshore natural gas resource. Now, this week, it raised a substantial amount of Aussie dollars to assist the development of its near production Amersfoort project. And it is... Yeah, the market cap on the ASX is 93 million Australian dollars, and Adam Sirakowski is the executive chairman. Thank you very much indeed. Adam, over to you.
Yeah, thank you, Sarah, and thank you to Master Investor and all the participants on this webinar. It's great to have this opportunity to update you on Kinetiko Energy's progress. So we are a company that is absolutely focused on onshore gas exploration and the progression of our already enormous discovery we've made in South Africa, in a wonderful location that is surrounded by existing energy infrastructure. Obviously, for those that are aware, the opportunity is very real for our company because there is an extreme local energy crisis. Most people in South Africa do not have availability to affordable and reliable energy, which I'll get to in a minute. Our project has the capacity to provide a near-term solution, taking our already large discovery and proving that up further into a development and production scenario in just a number of years. As Sarah alluded to, we have just finished a funding round very successfully in Australia. So the company is funded to conduct and complete a very exciting 5-well flow testing program, which it's planned to do over the next 6 to 8 months, and to commence in really just a number of weeks. As I mentioned, this is all underpinned by this substantial discovery, which is a contingent gas resource of some 6 trillion cubic feet in a 2C categorization. And we're here to tell you there's absolutely no risk that resource is going to grow even larger as we continue our baseline exploration program. Really importantly, we've made this discovery in a jurisdiction that hasn't had this sort of energy before it. I mean, South Africa has been a coal-based energy economy, and what we've discovered, we believe, is going to be a very low cost and potentially low risk development scenario that we can bring about in the years to come. So just a little bit more on that current South African energy crisis. It's very real. It's very much now. For those that don't know, power blackouts of up to 12 hours a day occur, and you can see from the graph in the right top-hand corner there, that's been increasing to a scenario where it virtually occurs at 100% every day of the year. It's called load shedding. It's incredibly disruptive to the South African economy, and there's a desperate need to find a solution. I mean, South Africa has depended on its coal-fired power stations for over half a century. Those coals are basically fed into power stations, and the coals are dirtier, they're deeper and more distant. So the economics of that aged coal-fired fleet is in rapid decline. In terms of other energy alternatives, certainly alternatives, hydro and solar, wind projects, renewables generally, nuclear are simply not an evolving solution for the country, and are not envisaged to be, certainly in the next decade and beyond, an energy solution. There is gas that has been available to the country that has come from Mozambique, an offshore field called the Pandey Temane production field. You can see in a chart on the right bottom side, that field has produced gas really reliably for South Africa for over 2 decades, but it is now going to into rapid decline. And as I'll show you in a minute, that gas, which is principally to support one of the largest South African utilities, Sasol, and their refinery at Secunda, is already telling downstream customers that they can expect to have gas supply cut off completely from 2026. There is a deep need to find a solution for this energy crisis. So I'll just tell you a little bit more about our assets. There they are, located approximately 150 to 180 kilometres southeast of Johannesburg, and I think, you know, one of the keys to this is their location adjacent to infrastructure. You hopefully recognise the black diamonds on the map. They're existing large South African coal-fired power stations. The red line roughly indicates that gas pipeline that comes down from Mozambique into the red square, which is the huge Sasol-operated Secunda coal to liquids and becoming gas to liquids refineries, one of the biggest in the world. And then that feed in the purple line is the Lily pipeline that descends through the company's tenements down to Richard Bay and major customers. So again, we have the potential to feed into an enormous electricity grid of power that's abundant in the region, and also this pipeline, and that can flow either way. So a couple of the key attributes beyond our location is our terrific success rate. The company's been in operation in South Africa, exploring for a decade, and it's enjoyed a 100% success rate in the 44 wells that it has drilled to date. All have encountered gas with significant shallow pay zones. Indeed, we achieved quite a milestone last year with not just the enormous certification of 6 trillion cubic feet of gas, as I mentioned, which is equivalent to 1 billion barrel of oil equivalent, but we also had certified from internationally recognised group Sproule our maiden gas reserves in a 2P category of 6.4 BCF over but a very small pilot. And that pilot down in the land holding category is identified there as being certified as only 0.2% of the granted tenements, which amount to some 6,000 square kilometres. So one of the obvious focuses and strategies of the company in the coming years is to step out and grow that gas reserve enormously. As I mentioned, we will grow the underlying gas resource. We have the ability to do that in two foreseeable ways. The first is that we already have a certification of a prospective resource of 5.8 TCF. We are drilling core wells every other month that will be used to certify and move that 5.8 2U into 2C. But in addition to that, I'd just like to reference that from the diagram, you'll see the yellow and orange tenements in our exploration rights 272, 271 and 270, and they are the tenements which contain our existing resource. A very large tenement out to the west, which is ER 383, some 2.3 thousand square kilometres, is in application and is expected to be granted in the next 6 to 8 months, and then will be added to our resource calculation. Is expected to increase that contingent resource significantly. So when we think about such a large opportunity in South Africa, in fact, probably at this time, growing to one of the top 10 onshore gas resources in the world, we look to have development partners, and the company's made positive steps with some domestic partners in South Africa to help build out our project in the decades to come. Just a little bit on the development characteristics. I'll just touch on these because we think these also tick a lot of boxes. As I mentioned, shallow conventional gas, we don't have any fracking requirement. The gas itself is in this conventional setting. It sits in sandstones which are above and contiguous with the Karoo Basin coals, which are significant in such a large part of this region of South Africa. And what we've discovered is that even in these low-lying formations, solid reservoirs of gas have been compartmentalized by enormous dolerite sills that cap the gas, and then dikes and faults that hold it into compartments. And it'll be our journey to interrogate multiple reservoirs to take out this mighty gas resource. From the testing we've done to date, it's a very high quality gas, 96 to 98% measured methane, with the remainder of hydrogen and very little CO2 measured. We have recently, only last month, been able to conduct and complete a gas to power proof of concept, where we used one of our early pilot production wells to co-fire a large gas generator, one of the first demonstrations of its type ever to be accomplished in South Africa. And we've effectively turned our high quality gas molecules into electrons, which is an exciting vision of addressing this energy crisis in South Africa. And we just mentioned there that it's also part of a process of modelling the fields that we put together in the future. And finally, that's we think that ticks a lot of ESG credentials as we look to be a really important part of the decarbonisation of the South African energy environment. Just a bit on our development strategy. As I said, we've been busy as an explorer in previous years. We've had that enormous exploration success. We now turn to our production vision, and we're very confident and convicted to what we can achieve with these 5 upcoming production wells to confirm flow testing characteristics. At stage 3, beyond that, we have an existing legal joint venture I touched on before with one of our partners. It's the Industrial Development Corporation of South Africa, and they have partnered up with us to drill a field of wells, which will start off as being approximately 20 in total, and the first 5 of those are programmed to be drilled starting in early 2025. And as that field grows to 20 wells, it is designed to produce gas from a micro LNG train, and we're hoping to generate therefore our first gas sales later in 2025 and revenues, which will be a very important milestone for the company. Corporately, I mentioned the enormous exploration right that we expect to have granted. That'll increase our resources, but probably more importantly is the grant of a production right. We're very advanced in processing the application for a production right and have it on our path to be delivered by the middle of next year, well in time for our first gas production scenarios later next year. Finally, we mentioned at stage 5, we have a larger vision, and I'll explain in a few more slides, a term sheet that has been executed again with the IDC to deliver South Africa's largest onshore LNG project, which at its first stage 1 represents 50 megawatts equivalent of energy. So we believe we have a clear sequenced execution strategy to develop this large asset in the years to come. Taking that strategy out a bit further, and really this is a slide that we use to really articulate the strong news flow as a listed company on the ASX. We want to provide news flow to investors on an ongoing basis and a reliable basis. So apart from the core wells that we continuously drill in country, we start this production testing set in the orange bar, and we expect flow rates to start coming out of the first wells as early as September, October, and we believe that we'll be updating the market every 4 to 6 weeks as we complete wells in sequence and provide results on those flow rates. And then you will see the company moving into further production wells with the IDC joint venture through the carriage of next year. There is additional production wells we've planned in other exploration rights, and we have the resources upgrade and production right potential that you also see there at the bottom of the chart. Just a bit then on our production test program we have coming up. I'll just draw a few points out here. It really is a focus of all our endeavours in the next 6 months, not only to achieve the highest flow rates and the best production data that we can, but I want to draw your attention to the map on the left that the privilege of our company is to be able to place these gas discoveries right where they're needed most. So you'll see the first well there is positioned right next to the Majuba power station. That is one of the largest in South Africa and has historically already been retrofitted to take gas to potentially co-fire it. And indeed, the second well you'll see is right next to the Lily pipeline. So in either of these scenarios, if we're successful in achieving high gas flow rates, and we're proving that the geology is unique in this region, the basis of that will be that we'll be able to put production clusters in the hundreds of wells in these regions to be able to produce gas into these very ready and available markets. We also have a high degree of confidence because we've done a number of core holes in this region, and over the last 2 years they've produced some of the largest gassy zones that we've ever discovered. In many cases, in excess of 130 meters of pay has been discovered. So for us, it's not a question of discovering gas, it's just now a question of how much gas we can flow. And on the Sproul report assumptions that are in place, 50,000 cubic feet of gas a day from flow rates is a baseline, and we expect to achieve far superior rates to that. So just quickly in terms of time, as I say, I'm already over. Just on the left is a picture of our proof of concept. That's a micro LNG train there being fed by a series of wells. This isn't our project, but it's a project that is in existence overseas. This is the sort of technology is available. It's very light touch. It's very scalable, and it'll be very easy to deliver in a quick period of time. On the right-hand side is a breakdown of the IDC term sheet that we have to deliver the largest LNG field in South Africa, as I mentioned, in its first evolution at stage 1. There are very attractive fiscal terms that has been offered to Kinetiko, and simply from that waterfall chart, if I could, it's approximately $138 million in capex that's been anticipated, 90 of which will be equity, 48 of which will be debt. But significantly, of the 90 million, the IDC is to contribute 51 for only 30% equity in the fiscal terms, which makes KKO's 70% for its modest contribution very attractive. That's the board of management. I'll leave that as read, and that's our corporate structure, which Sarah sort of mentioned, our current market cap. Our resource and reserves certification is there, and thank you, everyone.
Thank you very much indeed, Adam. Don't worry, I did actually come to you 2 minutes late. We do have 30 seconds. Now, your asset has been described as a world-class resource. I think you referenced that it's one of the top 10 in the world. For the sake of context, what can it be compared to, or are there no comparables out there at the moment?
Yes, Sarah, I've got to be careful here. In terms of onshore projects, it's very difficult to compare because most are deep conventional fields that have been discovered. But if we just simply turn to the resource number, I mean, any field that can come up with a number of 6 trillion cubic feet, and certainly over 10 trillion cubic feet of gas, and we generally believe that's a very achievable target. Anyone in the oil and gas industry can certainly reconcile how attractive that is.
Lovely. Adam, it's always a pleasure. That's Adam Sierakowski, the Executive Chairman of Kinetiko Energy. Thank you very much indeed. Take care. Thank you and good luck.
Thank you, Sarah.
Okay, well, our next speaker is the Chief Executive and Chairman of Tower Resources, the AIM-listed oil and gas company focused on Africa. It is Jeremy Asher, who earlier this month subscribed to many shares in the business to fund near-term working capital and to progress the work on the company's hopefully lucrative licenses. In the last conversation I had with Jeremy, he quoted, "The best time to buy is when there is blood in the streets, even if it's your own." A very warm welcome to you, Jeremy, and hopefully there's not too much blood in the streets.
Well, thank you, Sarah. No blood in the streets today, I'm happy to say. Thank you for inviting me to come and speak today and to talk about the oil and gas sector and Tower Resources in particular. We believe that the oil and gas sector is one of the backbones of the global economy, and we believe it's going to remain so for quite some time to come, whatever the IEA says. The fact is that we're all trying to see carbon emissions reduced globally and renewables increased in the energy mix, but we believe that also requires stable supplies of oil and growing supplies of natural gas to make these numbers work. And this is especially true in Africa. In fact, Adam was talking about this in the South African context, and also other developing nations where CO2 emissions are anyway very low at present, but more importantly, where current energy production is both inefficient and simply not sufficient to meet demand. And this is a great impediment to economic growth and prosperity, as also it's not very environmentally friendly either. So we're convinced that the world needs more short-cycle oil and gas production, and also more safe and economic long-term oil and gas reserves, simply to mitigate the long-term decline of existing reservoirs. And our mission, it's to help deliver this oil and gas. Now, as you can see on this slide 3, we have a broad asset portfolio in 3 countries, Cameroon, Namibia, and South Africa, and those encompass a different type of assets with different types of risk and timing. In Cameroon, our Tali license contains an existing discovery of oil on the Njonji structure, which we want to get into production as quickly as we can. And it also contains a significant amount of additional prospective resources, which we want to explore once we get Njonji producing. So I'll talk about that first and at some length, but then in Namibia and South Africa, where Total, Shell, and Gulf have recently made a number of high-profile discoveries, we also have high-impact exploration licenses in deeper water, which take longer and cost more to explore, but which also have the potential for even greater rewards. And I'll talk about those opportunities briefly as well. But as I'll also explain as we talk about Cameroon, exploration doesn't always have to be so risky. Once we have Njonji in production, we can also continue to explore in that same Dali license area for some period of time with very little risk. If we go to the next slide, this describes the Tali block, and it's a busy slide, which I'm not going to talk through in detail. We operate the block with 100% interest, and you can find these slides on the website and also a much more detailed presentation by my colleague, Duncan Rushworth, on all the details of the structures. But I'd like to draw your attention to two key points on this slide. The first is that we have some 25 million barrels of 2C contingent oil resources in the Njonji structure. That's the structure you can see towards the bottom of the map. There's oil in the reservoirs which are connected to the 2 discovery wells, which were already drilled by Total over a decade ago. We also believe there's a similar amount of potential prospective resources in the same structure, and that's in reservoirs which have not yet encountered a drill bit. The second key point is that there are a large number of other structures on the license area with a lot of additional volume, which have not yet been drilled. And you can see that both from the table and the map. But I'll move on. If we go to the next slide, you'll see here that there's a schematic on the left-hand side, which tries to explain what's going on and why the 2 discovery wells have not encountered all of the reservoirs. On the right, you can see the discovery well that intersected 3 of the reservoirs at the very edge of the structure. But we believe that there's several more reservoirs that are also present in the structure. And if you look at the right-hand well, the left-hand well, you'll see that this one is the other side of a fault, which sealed it off from those reservoirs also. So this is why our plan is to drill the current well, Njonji 3, near the crest of the structure. And if we go to the next slide, the idea is to be able to test all those reservoirs, both the ones that are in contact with the earlier wells and the ones that aren't, but also to see how they flow. But then our objective is to deviate and drill 3 further follow-on wells from that same location to different parts of the structure before commencing production from all 4 wells, which we hope will happen in early 2026. If we go on to slide 7, this slide discusses the economics. The economics are very attractive, and there are reasons for that. One reason is because we're operating in the shallow water, which is naturally advantageous. You've got relatively low costs, much simpler logistics, but we also have very attractive economics on the production sharing contract, and we're also benefiting from current favorable oil prices. I'm not going to go through this slide line by line, and the economics are simplified anyway, but I just want to draw attention to a few things. The first is that at 8,000 barrels a day of production with $75 oil prices, we generate gross revenue of over $200 million per year, of which 60% is available as cost recovery for the contractor before the profit sharing, which is already very substantial. So this means that not only do we recover the costs very quickly, but we can also recover the costs of further exploration in the surrounding structures in the license area for a period of 4 to 6 years, the remaining exploration periods under the license. We can recover the cost of those wells, even unsuccessful ones, and also the associated infrastructure too. So this is why I mentioned earlier that exploration doesn't always have to be risky. In fact, the Njonji prospect alone will be able to return its capital and make substantial profits, even if the additional resources we hope exist don't materialize, and especially if they do, then the returns could be substantially greater than what you even see here. So you might ask, what's the catch? Why is it already taken so long to get this project into production? It's a good question and goes to the heart of how the sector has changed over the past few years. Although this project can earn a lot of money, it's still fairly small in oil industry terms, and it's the kind of project which only independents would normally be interested in taking on. Provided the current appraisal well shows us what we expect should be able to get, we should be able to get debt financing for the rest of the development, or most of it. But we do need some higher risk capital now for the appraisal well. In the past, independents like us would normally share the project with like-minded independents, with partners, and we'd finance any amount we needed to fund ourselves by issuing shares on AIM. This was what AIM was originally created for, and this was our plan in 2017 and 2018. But by late 2018, the institutions had been most active in buying and holding the shares of small cap oil and gas companies on AIM were already withdrawing from the market, partly because conventional wisdom moved against oil and gas in general and against illiquid investments, and partly it reflected the broader withdrawal of pension fund portfolios from UK equities, which has been well publicized and has affected the whole stock market, but especially the small cap end of AIM. This has resulted in lower valuations, much less appetite for new share issues from small cap oil and gas companies on AIM. And so companies without production and without cash flow have really been limited to raising modest amounts of working capital. And shareholders expect companies like us to raise the larger funds for development from other companies or from investors at the asset level, which is understandable, but also sometimes easier said than done. Even companies with cash flow also have investors who want them to return money to them in dividends and share buybacks. So for them to co-invest with us in a new project like this, but also in a new country, this becomes a strategic decision for them. It requires thought, it requires analysis, it requires due diligence. In other words, it takes time, and different amounts of time for different companies depending on their circumstances. So right now we're in discussions regarding up to $15 million of asset level financing with several companies, and we're hoping to conclude those discussions not as soon as we can, because we're still planning to start drilling in the fourth quarter. Even our most committed investors, though, worry about when we will get this done, and personally I'm very confident about it, but I can't say more about the details of our commercial discussions in public, because those negotiations are still going on, and it'd be like playing cards with all our cards face up on the table, which nobody does. So that's why getting the financing in place for the appraisal well is time consuming, and also everything that involves getting approvals and so forth takes time in our industry, and we realize this is a risk for investors. If we turn to slide 8, I'll talk about Namibia briefly. Namibia is a different kind of risk. It's pure exploration risk. We have over 23,000 kilometers in the Walvis Basin. We own 80% and operate this license. In the Walvis Basin, we're somewhat to the north of the Orange Basin, where Shell and Total and Gulp have made their recent discoveries. But we know that the Walvis Basin also has source rocks and a working petroleum system that's already shown up in the wells that have already been drilled there in the last few years. And we know that we're in good company with Exxon both to the north and to the south, and also Chevron to the south, and other companies nearby. Our basin modeling has shown us where the oil and gas kitchens are mature and the kind of volumes they should have expelled over the long geological timeframes since they reached maturity. And if we look at the next slide, you can see a little bit of that also. The geological analysis has also shown us where the possible migration paths for the oil lie, and we've compared those with the oil seeps that we can see over the area using satellite images. And at the end of last year, we confirmed that these match up very well. There's a detailed presentation of this technical work from October 2023, which you can also find on our website. So we're now completing the prioritization of the most interesting of the leads along those migration paths prior to choosing the most promising areas in which to acquire more 3D seismic data. We already know from our previous work on the license area that we have some giant, and I mean really giant, anticlines at the end of some of those migration paths. But we're also now seeing some giant stratigraphic traps which in many ways we're even more interested in, along those paths before you reach the giant anticlines. Once we've completed this work, I expect we'll be looking for a partner to fund the 3D seismic data acquisition itself. If we turn to slide 10, in South Africa, we also have a high-impact exploration license, which we hold in a 50-50 joint venture with the operator, which is New Age. Here, we're nestled between Total's blocks to the west and Shell's blocks to the east, and the deep water section of the license, as you can see on the chart, juts out into the Kinetiko Basin, which is where Total's Brulpadda and Leopard discoveries have been made. The operators identified a giant lead here with separate potential reservoir layers in the deep water slope and in the basin floor fan. The next step here remains, as in Namibia, to acquire additional 3D seismic data over the lead. And this process, well, it's been slowed down somewhat by the new petroleum legislation being enacted. But it now looks like this process is moving forward again, and we are currently in advanced discussions with a third party to finance that work at present. So to conclude on slide 11, which I already showed you, as you can see, we have three very interesting assets, but with different timing and risk profiles, but all of them offer great rewards. Our priority in the short term is Cameroon, since this is the quickest and surest route to production and cash flow, and that changes everything from an investor's perspective. But once we have that, the longer term prospects, both in Cameroon and in Namibia and South Africa, are also enormous. Tower's the type of oil and gas company which AIM was originally intended to finance with growth capital. Today, AIM is not such an easy place for pre-revenue companies, and this creates some extra risk for investors, as there are no longer so many institutions that are there to keep providing extra capital if private investors don't want to do it. And oil and gas is also a sector with naturally long timeframes. It takes time to get things agreed, time to get them approved, and then it takes more time to actually get things done. But just as there may be extra risks, there are also exceptional rewards for investors who can understand the sector and are comfortable with it. I'll finish by just repeating that there's a lot more technical information on our website, and SP Angel also produced a detailed analyst's report in December, which you can also find on SP Angel's website as well as on our own. Thank you very much.
Thank you. Thank you very much indeed, Jeremy. You know, it's always marginally terrifying when one becomes known as a veteran of a particular industry. However, you do have that moniker, as it were. So I'm just wondering, just how well connected are you? You talk about Cameroon. So does the company have a direct line to the Prime Minister of Cameroon, for example?
Well, yes. In fact, we've had a huge amount of support from the government. Everything in Cameroon there's a very strong rule of law, and everything is done in a very systematic way. So you've got the National Oil Company also involved in everything that we do, the ministry, of course, and they have a strong technical team. But the Prime Minister takes a very strong personal interest in what we're doing, and ultimately everything has to be approved also by the Office of the President. So you've got a strong political support system, and there's a very strong desire on the part of Cameroon to see new players coming into the sector and for production to increase again, because production in Cameroon hit a peak of about 160,000 barrels a day a decade or so ago, and it's now merely about half that.
So I'm just wondering, so you've got the political support then. What is the biggest challenge to the juiciest part of your portfolio? Is it getting rigs, getting extensions to initial exploration licenses, or, as you've explained very gently, about fundraising and the different dynamics within AIM?
I think that for us, it's been different things at different times. The rig market was extremely tight after the Ukraine invasion. And the reason for this was simply because Aramco made the decision to massively increased the number of jackup rigs that it was using in its shallow water production. And they took most of the available rigs straight out of the market. So whereas the deep water drill ship market improved gradually, the jackup rig became very, very tight very, very quickly in 2022-23. This year, 2024, it's actually becoming a bit easier because some of those rigs have been released from the Middle East. So they're finding their way back to West Africa, and rigs is no longer the issue, even though the rig that we already have contracted to use with Bor is currently delayed because of, this is one of these things that happens in the industry, you just get delays to programs. So rig's not so much the worry now. Having the money and time for when the rig's finally ready, that is very important. But there's a bit of chicken and egg with these things, because when you've got the rig deadline right on top of you, everyone's mind is concentrated. And then when it seems like you've got another few months, people say, oh, well, maybe I'd take. And, as I said, these are important decisions for the companies we're talking to. And we don't want to hurry them up. We want as much time as they need to make sure that we get the best proposals that are best thought out before we move forward. So it's different things at different times. And then when we've drilled this well, we'll still have to go through some approval processes before we do the next round of drilling, and there'll be procurement on long lead items. So there's always something.
Okay, so you and I have discussed this before, but the market cap seems so low relative to the expected value of the projects. And Dale asks, do we have an expected share price for the end of 2024?
Well, I'm not supposed to really talk about the share price, but what I try to do is to show what I think by my actions rather than my words. That's why I bought shares just a couple of weeks ago. But what I would say is that SP Angel have done quite a detailed analyst report, and the assumptions that they've made are all laid out in great detail. It's very transparent. And I think their target price was 0.12, which is an order of magnitude higher than where we are now. So what I would suggest is that if one's interested in where the share price could go, both in the short term and also in the longer term, take a look at SP Angel's analysis. It's quite interesting.
I will do, and we will do. Jeremy Asher, thank you very much. It is indeed a pleasure. And yes, Jeremy, that wasn't Jeremy's quote. Jeremy quoted somebody else's quote about there being blood on the streets. I could see that there were some comments coming in. So no, Jeremy wasn't taking credit for that quote, but it's a good quote nonetheless. Jeremy, thank you very much. Thank you. Okay, to our final presentation of today's event, and thank you very much, and thank you for the questions as well. The final presentation is Mosman Oil and Gas. It's the AIM-listed helium, hydrogen and hydrocarbon exploration, development and production company. June has been a very busy month for this business as it repositions itself to focus on its helium projects. Andy Carroll has been with the company for many years and was made its chief executive last October. Andy.
Good to see you, Sarah. Thanks everybody for joining this afternoon. So if we kick into the slideshow, we're looking at three commodities here, but focusing primarily on helium as our focus going forward, and hydrocarbon as where we have been and have some heritage assets. So if we kick on through the disclaimer into the next slide, lays out the key points of the Mosman opportunity. First of all, the market cap. So we have good liquidity and a very modest market cap. On the right-hand side, you can see the comparison with the other AIM helium companies. I think Helium 1 has actually recovered from that snapshot from last week, but we are significantly lower market cap, I think because of the issues in the past with capital raises, which have repeatedly sliced the share price. We've now rebooted, cut corporate costs 40%, and are able to now announce and roadshow the helium focus, which has been actually work in progress over the last 2 years, and with assets that we've had for a long time in which helium potential has become very juicy. And I'll talk about the helium price, which has driven that. So our two core assets in the Commodities basin in Australia, where the helium percentages are very high by global standards, which is very important in the commercialization process. EP145, we have the exploration now funded by farm out to ASX listed company Greenvale, and 155 funded by farm out also. The new news that really enables us to talk about the full pivot into helium is the step acquisition into a helium project in Colorado, USA, that I'll talk about in more detail a little later. The near-term activity with 5 wells to be drilled before Christmas this year, picking up on Adam's point, low-cost drilling is a good thing, and so these are also shallow wells, which enables low cost. I think our well cost is perhaps 1/10 of the helium well cost in Montana, and that's one of the reasons that we find this area very attractive. It also has our key criteria of a high helium content. So our pitch is that we are compelling undervalued helium opportunity. Callum talked about the hydrocarbon or the oil and gas price matrix. Interesting in Europe, the gas market won't be complacent. In the US, 3 years ago, we were producing gas and selling it for over $7.50. Earlier this year, it went below $2. It's now recovered, but it's still below $3. So we're talking about something that helium that's 100 or 200 times more valuable than methane hydrocarbon gas. We're also able to target low-risk locations in a proven helium area, and simply put, that would be not a question of whether helium is there, it's a question of what percentage of helium we will encounter in these areas. I touched on the market cap. I think what also stands out for an exploration company is that we do actually have cash flow from our oil and gas assets in Texas. But going forward, our strategy is to expand on the helium. So next slide, please. Touch on our existing assets. We have enjoyed strong revenues from our oil and gas projects in Texas. It's not a big step for us to move into Colorado. Our man in US is based in Dallas, which you can see is not that far, in fact, from Colorado. And in Australia, our exploration is so well advanced that we have a prospective resource. If you take that 20 BCF of helium, multiply it by the current helium price, you get the remarkable number of $13 billion. So very significant potential in the helium sector, primarily due to its price. Next slide, thanks. Our team, I've shifted from technical director to CEO last year with a bit of reorganization. Our man in Dallas is very experienced. At one stage, he was the head of global exploration for BHP. He now is very keen to lead our business development in helium. He actually studied helium at university in Saskatchewan. He grew up in Canada, where there has been an ongoing helium business. Very in-depth experience in the US, where we are very comfortable. I think one of the other speakers talked about time taken for applications and developments and approvals. We actually moved to the US. We moved out of New Zealand into the US because it's very simple and easy to operate in the US. That's why we're happy with that being one of the operating areas for us. Julie Dawes has been working helium exploration for the last 5 years, as it became clear that our assets in Australia, that the juice was really in the helium content, still strong economics in the oil and gas potential, but helium is the standout, and we have a strong technical team on board with obviously a virtual organization of consultants, but a very cost-effective structure. Next slide, thank you. And going into the helium strategy on the next slide. So, Callum didn't get into the helium price, but look at that trend. Clearly has kicked off in the last few years and is heading skywards. Why is this? Because supply in the US is in decline, and on the right-hand side, you can see demand for helium. So we are in clean tech engineering applications. So one of the investors mentioned investor interest in oil and gas is in decline. It's looking at things like semiconductor manufacture with NVIDIA, a big consumer of helium. SpaceX, space rockets use a significant amount of helium, MRI, and a wide range of science and technical applications, all of which require helium, and expanding market at the same time as global supply is in decline. And most importantly, US supply is in decline. We're very happy to be supplying domestic markets in both US and Australia, where there is a shortage. Next slide, thank you. So the strategy is not a recent pop-up. We have had the areas in Australia in the Commodities Basin for since IPO about 10 years ago. And it's really the shift in helium price which has brought this to the top. We've done a global review of where we want to be. We're very happy to be in Australia, and we see the opportunities in the USA. So move next slide. I'll talk about the what we think the key ingredients are. As I say, we like the US and Australia. It's the right area to invest. Some areas in the US have the high helium percentage that we see in the Commodities. I agree with the previous presenter talked about infrastructure and drilling costs. So where we are moving into the US, very low cost. In the Commodities Basin, the costs are not so low. So we have managed that by farming out where the drilling costs are higher. But we do like to be where there's established production, and we are going forward very much focused on the helium opportunities. Next slide, thank you. So looking at the areas in Australia, our permits in purple, EP 155 and 145. 145 is geologically an extension of the Mereenie anticline, where that oil and gas field has been in production for over 30 years. The little red dotted line going up, which is north from Mereenie and Palm Valley, is a gas pipeline to Darwin, where there is an existing helium plant, which is now becoming available as the offshore gas field that it was servicing has gone into decline. Great infrastructure. You can fly into Alice Springs, rent a truck, drive out to Mereenie, drive out to our permit, road and rail going through Alice Springs. Significant drilling activity in the area, and importantly, the helium percentage is high in those areas to the south, but at Mereenie, there's not above the right basement rocks, which you see in the dark green. It still has 1% helium, and the price of helium now means that the operator is looking at putting a helium extraction plant at Mereenie. So good to see that that's moving ahead. They're one step ahead of us, but we're not far behind. Next slide, thank you. So we are sufficiently advanced in 145 to have prospective resource, big numbers. We've got a wide range on that, lots of upside, but we recognise that there's more work to do. We have got 2 wells that were drilled in that permit, both of which found hydrocarbons but were not tested for helium. So, but we are surrounded by wells that do have helium. And so 145 we like because it's advanced, but as one of the other speakers said, it's nice to have a sequence in your portfolio. And 145 is also high potential, but a little more work to be done at 155. Next slide, thank you. So in our move to helium, which has been worked on for some time, we recently announced the acquisition of an interest in the USA, which is the areas in bright yellow there within the broader yellow county of Las Animas in southeast Colorado. See that conventional helium extraction was from a low percentage in that large red gas field in Kansas and Oklahoma. US government had it nationalized, helium nationalized as a key commodity for when Nazi Germany was looking for dirigibles, and after the Hindenburg decided hydrogen wasn't the right way to go. Been nationalized, and helium collected and stored in the storage facility in Texas. That field is in decline. The storage is getting used up. It's been privatized, but we're very happy to be adjacent to heritage infrastructure, which is obviously connected to the markets. And the markets include now domestic market of semiconductor plants being built in Arizona. So helium can cryogenically separated on the lease, trucked in small quantities or by pipeline in larger quantities. And there is already helium production in Las Animas County that I'll touch on the next slide. So focusing in, helium comes from uranium and thorium material in the granitic basement. It needs faults and a migration path to get up into here. It's the shallow reservoir of the upper Lyons. There are other deeper targets, but the upper Lyons is very attractive and demonstrated production. On the right-hand slide, the red blob in the middle is the model dome, produced before helium was privatized, nationalized by the US government, depending where you get your numbers from, somewhere between 7 and 11% helium content proven at helium at model dome. There were some deep wells. Texaco drilled a well here looking for oil and gas when oil and gas prices were high in the 80s. That didn't find any hydrocarbons, but it did find strong helium numbers. And further to the east is presence of helium, but as you can see in the diagram, there's some CO2 coming into the system. Now, some people think that we can make money out of CO2, so it's not a deal killer, but it does mean that your helium percentages tend to be a little bit lower. We're fortunate in this area that there's a listed company called Blue Helium listed in Australia. They have the blue lease areas there and going into development. And in some of the leases that they didn't pick up, there's an active private company drilling and producing helium in this area. So we're quite happy to come in behind and pick up on their lessons learned, and very keen on this low-cost drilling in a proven helium province. Next slide, thank you. We are in the happy position of having our exploration funded. As Jeremy was saying, it's becoming increasingly difficult on AIM and generally in the capital markets to get people interested in risk projects. So we have funded 145 by farm out, funded 155 by farm out. The exploration costs in our US acquisition are modest, and we're able to fund those from cash flow and the sale of oil and gas assets. Pleased to have announced the first sale of oil and gas assets that's due to complete in September. So we are happy to have funded exploration with 5 wells to be drilled before Christmas, followed by drilling in 145, followed by 155 in due course. Next slide, thank you. We do still have oil and gas assets, and next slide, I'll 2 main areas. One that we call Cinnabar is in Texas, and Stanley, which is in Texas near Houston. Stanley, we have a sale contract for $1 million on completion, plus other payments that are subject to performance criteria. We participated in drilling 5 wells there, all on production. We've enjoyed strong revenues, but when oil price is strong as it is now, it's also not a bad time to cash out and get rewarded for the current production, but put the money in the bank and use that money to fund the helium exploration. Cinnabar was, we know there is a lot of oil in the ground at Cinnabar. There are 2 wells that have been producing since the 1980s, still producing. That holds the leases. We drilled a well which had some operational issues in drilling with lost circulation, and it was still working to resolve how to get that well on production. But the primary focus has been Stanley, and one of the benefits of selling Stanley is to be able to, our small team, to be able to focus more time on resolving the issues at Cinnabar, but also more importantly, to focus on helium exploration going forward. Next, thank you. And next slide. So our final slide today, we have the near-term activity with the Vector Helium project with 5 wells before Christmas, 145 seismic this year, drilling next year, 155 following on behind that. We see significant value add on the remaining asset in the US, but we're not planning to put a lot of money into that asset, but we do see that we can add significant value. We're looking forward to the completion of the sale of Stanley and very much helium focus moving forward. So that's the presentation. Thank you, Sarah. Open it up to questions.
Many thanks. We've only got 30 seconds left for questions, but how clever of you to incorporate NVIDIA into your presentation, NVIDIA being the most valuable company in the world due to the AI frenzy. And of course, as you explained to us, AI needs helium. And so therefore, it just underscores how undervalued you are, which brings me to Chris and Dale's comments. Chris says Mosman is currently 10 times undervalued compared to Helium-1 and Helix exploration. So what do you see as fair value for Mosman? How will you get there, and in what time frame?
So a key part of that process is we transitioning from oil and gas to helium. There's a certain process for AIM companies that are changing direction. So we had to manage the sale of the asset so as to not trigger any AIM concerns, and also manage the acquisition of the helium project in the USA. We did look at alternative ways of doing this last year, but it's really now the 2 deals that we've announced in the last few weeks that have allowed me to come and talk about Mosman as a helium company. And I think helium has not been on the radar, perhaps, you know, as Callum said, he's a commodity analyst, but he doesn't cover helium. It's not on everybody's radar. But I think the investors are a little smarter than that, and and clearly there's been interest in helium-1, and Helix has done very well. I think Mosman, it's only now that I can roadshow and talk to the market about the helium assets that we have and allow the market to be informed and make their own opinion about the valuation of Mosman, given the quality of our assets, the revenue from our existing assets, and our cost structure, our technical team, and the path ahead.
And that path ahead, Chris is just asking about the time frame.
So we see the vector wells being drilled before Christmas this year as near-term activity. We do see other business development opportunities. It's a very underfunded out there. There's lots of small private teams that are desperate for funding, as with Vector. So there's more business development opportunities, but primarily in terms of what's on the table at the moment, it would be the Vector wells before Christmas and activity in 145 as well as 155.
Lovely. Andy, we'll have to leave it there. Andy Carroll, the Chief Executive of Mosman Oil and Gas. Thank you very much indeed for joining us. It's been superb. Very clever about incorporating NVIDIA, and very impressed. In fact, I'm very impressed with all our presenters, and a big thank you for Callum for being the scene setter. His commentary has been referenced throughout a lot of the presentations that we've heard this lunchtime webinar. So our next lunchtime webinar is Thursday, September the 19th, where we are going to be discussing AI technology. So I'm sure that NVIDIA will get an honourable nod in that as well. But for today, on behalf of myself and the rest of the Master Investor team, thank you very much indeed. It's been a real eye-opening, enlightening webinar today. Thank you.